The year is 1987 and you're a trader at Goldman Sachs. You're making a killing on the markets from your big institutional clients and your personal ones too, taking hefty cuts in commission from buying and selling shares. More and more people are owning shares, more trades are taking place than ever before, and you finally made enough to buy that Ferrari Testarossa that you've always wanted. Back then there was no internet, no smartphone apps, so this was all done on the phone in real time. The average commission per trade was $45 or around £35. Once you multiplied that by a few thousand times, you were doing pretty well. Even the Wolf of Wall Street, Jordan Belfort himself, would have approved.
Oh, it's perfect.
But in just a few short years, that would all change. Fees would slowly decrease as more competition entered the market. Technology-driven disruptive companies would change the trading world as we know it, allowing anyone with an internet connection access to the stock market from anywhere in the world. In the US, companies like eToro emerged, empowering traders with zero commission trading. Investing in stocks would no longer be reserved for the rich, the powerful, and the suits. The man on the street was back in charge, and boy did he mean business. But the old guard on Wall Street weren't going to give up their fees that easily. They've been playing this game a lot longer than you have. Behind the scenes, commission-free trading has a few more tricks up its sleeves, but before we expose what's really going on, how the hell did we end up in this situation? Commission-free trading has taken the world by storm. Over in the US, platforms like Robinhood have shot to fame, becoming one of the largest companies to IPO back in 2021. And here in the UK, we've had our own boom of retail trading too, with companies like Trading 212, Freetrade and eToro all taking their part of the pie, as the excitement for stock market rocketed to all-time highs. Millions of first-time stock pickers made their trades using an app on their mobile phones last year. Trading 212 said they had over 14 million downloads, and it's been the most downloaded trading platform in the UK since 2016. Freetrade also noted that at the end of last year, they had over 1 million new customers sign up to their platform too. Commission-free traders and the rise in interest in the stock market in general both fueled each other and was propelled even further with the addition of Wall Street Bets, the Reddit thread of traders and investors who came into the limelight after the short squeeze on US video game retailer GameStop. In January of 2021, keen-eyed traders noticed that GameStop stock was being shorted by over 140% of the shares available. With some clever community action, traders worked out that they could force the price by betting against those short sellers. By buying and holding enough of the stock, they'd force the shorts to cover their position, which effectively means buying more shares. But with no shares left to buy, the price gets pushed further and further up, causing a chain reaction effect and a short squeeze, creating huge losses for hedge funds and institutions that were betting on the price of the company to keep falling. A truly game-changing event for retail traders empowered by easy access to the market. But it wasn't always like this. Here's how it used to work. To buy a share of your favorite company, you'd either pay a percentage fee or a fixed cost to trade as a retail trader. And in fact, most traditional brokers still charge in this way, meaning that for smaller accounts, fees make trading pretty uneconomical. For example, some UK trading platforms will charge over £10 per trade, regardless of how much you want to spend. So when you only want to buy a couple of small shares, you probably just forget about it. Now though, you can log in, deposit a small amount of cash straight from your bank, or even use Apple Pay to buy a single share of a company worth £3 and pay no commission at all. It's as easy as that. Every little helps. But hold on, what's the catch? Nothing is free. There's always money to be made somewhere, and those guys on Wall Street aren't going to go down without a fight, right? Well, something like that. And here's where the controversy comes in, and it's slightly different for us in the UK compared with those over the pond in the US. Let's start with those guys first. In order to fund their platform, Robinhood makes money in several different ways to make up for those lost commissions. One source is through trading of options contracts, effectively the bet of a price of a stock going up or down, without technically owning the stock. You can make and lose a lot more than you put in here. The second source is through the trading of cryptocurrency. Robinhood will make money in the spread, the difference between the buy and those sell prices, and they've done pretty well on this part. But the most important part of their business, and the most controversial, is what's known as payment for order flow. To understand this, let's briefly go through what happens when you place an order on platforms like this. If I want to buy a share in a company, I need someone to sell it to me. It's as simple as that. But there are hundreds and thousands of people buying and selling at the same time from many different sources. So someone in the middle has to match up those buyers and sellers and effectively create the market. Without buyers meeting those sellers, then you're pretty much stuck, which is where organizations called market makers come in. Now, these organizations make money in differences between the buy and the sell price, which are typically really small differences, fractions of the price, maybe just a few pence. Market makers take on the risks involved in creating that market. For example, matching up 10 different people selling 10 different shares to one larger trade for 100, for example, and they may even trade shares for themselves while they're at it too. Now, here's where the payment for order flow comes in. In theory, a broker should place your order with the market maker with the best price for you and work in your favor. They should get you the best price for selling and the lowest price if you want to buy. However, some market makers will offer brokers money in exchange for taking all of their orders. This causes two things to happen. Firstly, you might not always be getting the best price if your order is going to the market maker now paying for your orders. And secondly, the market makers gain knowledge on what is happening on the market at any one time. Once a market maker can see thousands of orders coming in to buy and sell a stock, or even options contracts, they've got the ability to influence the market. They could even route their own orders in front of yours, for example, if they think that the price of stock might go up. This practice is so controversial that it's actually banned in the UK, so we don't quite have to worry about those issues, but we do have a few others. Here at home in the UK, our range of popular free trading apps are making their money in several different ways as well. Some are even losing a lot of money too, but more on that one later. Now, one of the most popular brokers who are currently not taking on any more UK customers, but probably will shortly in the future, is Trading 212. Now, they offer zero commission on trades and even a completely free stocks and shares ISA. This means that the average trader can actually build up their wealth with no fees at all on their platform. But in their most recent company accounts, we really get a picture of where their money is being made. Now, as you can see on screen, Trading 212 made £54 million in revenue last year, but most impressively, look at these numbers. Nearly £27 million in profits. That's a 50% margin on their business. But there aren't any fees, so where's the money coming from? The answer is CFDs, which stands for Contracts for Difference. And they're effectively options contracts allowing traders to bet on the price movement of a stock with leverage, meaning you can lose more than you put in. Now, most people lose money in this practice, it's just a fact, and the proof is in those numbers. Trading 212 makes money either way, as they make money in that spread, the difference between the two prices. They do know that they want to start making money from their investors somehow, but time will tell what they start to do. But for now, the people allowing you to trade for free are the gamblers losing their money on the other side. Other platforms like eToro are similar in their business model. Their income's coming from foreign exchange fees, spread costs, and even withdrawal fees. eToro doesn't offer any tax efficient accounts either, so no stocks and shares ISA here. And this means that you'll need to be really careful about making any sizable income, as it will all technically be taxable. I really don't think the average person has any clue that this goes on, but these are the facts. It's kind of like the currency exchange places at airports. They literally have massive banners saying 0% commission. So in your head, you think, great, that must mean that I'll get a good price. But the money isn't in the commission, it's in the spread. You don't need to make extra commission when you buy and sell prices are already so bad that by the time you've handed your money over, they've already pocketed a nice 5 or 10% or so difference. One final example from the UK side is the popular platform Freetrade, who also offer a completely free trading platform with some freemium features on top, which is a monthly fee for stocks and shares ISA, or a premium plus account if you want some additional features. But even with those charges, they're not currently making any profits and still have a long way to go before they'll actually be profitable. They did manage to raise another huge sum of money through crowdfunding recently, and I've got no doubt they'll figure out more ways to monetize. But again, it's another reminder that nothing's free. What does this all mean for you then? You're not stupid and you know that companies have to make a profit, but you also want to invest with as little as cost as possible. Well, we're in a situation similar to lots of other industries right now. Freemium is everywhere. Anyone remember Farmville, that free-to-play game back in 2009 that you would play through your web browser? It was all free to play, but if you wanted to speed up creating your virtual crops, you need to buy the in-game virtual currency. It's very similar with games like Candy Crush, Call of Duty Warzone, Clash Royale, you name it. A small number of people who pay for those premium features pay for the platform for everyone, so all the players can benefit. They rake in so much money too, it's unbelievable. I'd probably have to make a whole video on how much money these guys are making. The big question is, will this work in the investing world? And are you happy to use a free service knowing that the reason it functions is because loads of people just lost a ton of money betting that a stock would go down and ended going in the other direction. Basically, you're able to have fun on one side, and then when you go through the door, someone's losing their money in the casino. Now, that's up to you, but either way, it's always good to know where fees are being made and what the real costs are behind the scenes. It's the same questions you have to ask yourself when you invest in big dividend-paying stocks like British American Tobacco. Are you happy that the money in your pocket comes from that industry with all of the harms it does, regardless of the taxation money that it brings in? It's up to you. So what's the bottom line then? Overall, I think competition in this space is always a good thing. I'm really happy to see new disruptive platforms take on those big boys from time to time. I want to see trading and investing, more importantly, accessible to as many people as possible, because it's one of the only ways that you can really grow your wealth in the long term without being someone like a business owner. Making fees free or as low cost as possible really helps get more people into the market, but we must always be super skeptical and remind ourselves that there's always a cost somewhere, and that someone has to pay that cost. The trick, I think, will be finding where the balance lies, and will there be enough willing participants to pay a monthly fee for premium features, for example, to cover the costs of those who are not willing to pay. Either way, just be careful out there. Make sure you invest with an FCA regulated companies, which all of the brokers I've spoken about for the UK are. Be skeptical and always on your guard, because there's always people who want to take your money away. Never trust people who promise massive gains or claim to know what the next big stock's going to be. If you'd like to get started with any of them, see the links in the description below, and please check out my channel for loads more videos on getting started investing and lots of other content. I really appreciate you watching until the end. Drop me a like if you found the video interesting, subscribe for many more. I'll see you in the next one. And in the meantime, happy investing.